Namaskar, this is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. Bank takeovers, bank mergers, bank amalgamations, bank consolidation. These happen to be a common phenomena in the banking industry worldwide. But then, while in the case of banks abroad, mergers of banks take place because of market phenomena primarily, because of market denominated factors. On the other hand, in India, they have taken place because of government mandates. And that's because the government continues to own most of the large banks in India, and it still has a dominant share and control over the banking industry in India. These mergers always are found to take place at times of adversity, whether they are mergers on account of market forces or on account of government mandates. The general experience is that when there is adversity in the banking industry, in the economy, and in the global economy, it triggers a spate of bank mergers as they struggle to survive or they struggle to get bigger and better. It was in 1997-99 that the world witnessed the Asian financial crisis, and at that point of time, the world also witnessed almost 700 bank mergers in Asia, Europe, and America. In 2008, we witnessed an economic meltdown of America at a time when leaders like Citibank were doddering and shaky, and Lehman Brothers had also collapsed. At that point of time, America witnessed a spate of bank mergers, bank closures, bank consolidation, and bank takeovers. In India, we have had about 30 cases of bank mergers since 1991, and most of them have been of public sector banks. And the overall experience, conclusion, and the result out of these mergers has been nothing great to write about. It has not been encouraging. It was in 1991 that the Narasimhan Committee recommended amalgamation, consolidation, and mergers of public sector banks in India to make them what they call bigger and better, with bigger balance sheets and better management practices. Actually, nothing of that sort really took place. But since then, we've had a number of bank mergers for numerous reasons. New India Bank was taken over by PNB. It resulted in nothing great for PNB. There was no improvement in its balance sheet of any sort. United Western Bank was taken over by IDBI Bank, and both became bankrupt. Global Trust Bank was taken over by Oriental Bank of Commerce, and now this bank is so weak that it is being taken over by yet another weak bank, which is Punjab National Bank. Then we had the 5 associate banks of SBI being merged into SBI, and that happened 2 years ago. And since then, the overall balance sheet of SBI has only weakened. They do not add to its strength at all. ICICI Bank in this period took over Bank of Rajasthan, Bank of Madura, and Sangli Bank. Nothing spectacular came out of it for ICICI Bank in terms of finances or profitability. Perhaps the only notable success in all these bank mergers in India has been that of Kotak Bank taking over ING Vysya Bank and HDFC Bank taking over Times Bank and Centurion Bank. So, no greater story of bank mergers in India, but that also is a global phenomena. The Bank of International Settlements in a report says that actual benefits or gains arising out of bank mergers are not to the extent to which they are claimed to be. And yet another study of bank takeovers and mergers over a 20-year period says that bank mergers do not really achieve the kind of economies of scale that they are perceived to be, and neither do they really enhance managerial efficiency and ability of these banks. Despite that, we are now witnessing a spate of bank takeovers and mergers. As the government says, it is converting or creating 12 banks out of 21 banks that it owns. Such bank mergers can be justified or done for reasons of cost cutting, ensuring that the costs of the resultant entity are lesser than those that got merged into it, for reasons of better profits, better income, for reasons of making the bank bigger such that it is able to compete in a better way, making a larger entity so that it is difficult to be taken over, and most important, the objective should be that managerial efficiency of the resultant merged bank is much better than those banks which were merged into it. And if you analyze the entire proposal to merge banks and make bigger banks in India, you will realize that it does not make sense. It is not going to really add value the way it ought to be. And what are the reasons? The first one, what is being done is only adding up inefficient banks into a bigger inefficient bank. Banks with a weak balance sheet are being added together. That does not add into a strong balance sheet. So it is not a reform of any sort. A reform is one where there is a change in regulation which transforms, where the government vacates a place where it is there at the moment. For example, if these banks had been privatized, it would have been a banking reform. Adding weak, inefficient banks and making them into one lump sum does not really mean a reform, and neither does it build a size which will add to the competitiveness of these banks. Thus, no global scale or no bank of a global size is also being created. Take the biggest entity coming out of these mergers, PNB. PNB has got OBC and United Bank of India merging in it. Its combined balance sheet post-merger is expected to total to 18 lakh crores. That's about $169 billion. And if you actually look at the global statistics, the 100th largest bank in the world by ranking, by assets ranking, is a bank called Bankia Spain, and its balance sheet size is $243 billion. So mergers are not creating any bank of a global scale or size. It does not really help. And even if you are, big does not necessarily mean efficient and profitable. Take the case of Deutsche Bank, the largest in Germany and among the largest in the world. It is doddering at the moment because of inefficiency and mismanagement. So big doesn't really mean anything unless it is efficient, and it is management practices which define an efficient bank or make one. And without those changes taking place, making a big entity will only mean a bigger mess. What is being done is we are creating entities which will become what are called too big to fail. And too big to fail entities create a systemic risk. When they go in a problem, they have to be saved at any cost, and that does not help any industry. The other reason why we think that this entire exercise is going to achieve little is the fact that whenever there is a takeover or amalgamation or merger, there are challenges of integration of the organization, integration of cultures, integration of systems. At the moment, the priority for all these shaky, weak banks which are being merged is battling for survival, is battling the NPA crisis, is strengthening their finances. And now, once they get into the merger mode, their focus will shift on the integration process so that the integration doesn't fail. Their priorities will shift, and that's not going to do them any good. The other reality is that this merger is no cure for the NPA crisis that we face today, in case the government claims to say so. If new laws, new regulations, the insolvency bankruptcy code could make little dent in the NPA crisis that we face, mergers of these banks which are loaded with NPAs is not going to cure anything. And that is one of the failures of this entire exercise. NPA crisis will not be cured. In fact, what we are doing is we are adding various weak banks together and making another weak entity. What does it really come out of it? And because that's the kind of emerging entity we will see, the government's objective of attracting foreign investment in the banking industry into public sector banks will not succeed. At the moment, while new private sector banks have 43% of their capital subscribed by foreign investors, and old private sector banks have 27% of their capital subscribed by foreign investors, the foreign investment in public sector banks is a mere 4.3%. And by creating these kind of weak entities, it is not going to encourage foreign investors to rush in. So even there, we achieve nothing out of these mergers that are being proposed to be done. The reality is that the biggest problem that banks face today is a weak balance sheet, weak profitability, weak capital, and that all has to do with an NPA crisis. That crisis we face is systemic. It has nothing to do with the size of the bank. It is a crisis which has occurred because of political and bureaucratic interference in banks and the corruption of bankers. It has occurred because of an integrity deficit, mismanagement of banks. And how is that going to be cured by virtue of mergers and amalgamations that are proposed? Yet another reason why nothing will come out of it is that every banker who works for a public sector bank knows that even if everything goes bad, even if the bank goes bankrupt, which is what has happened at the moment in case of 11 public sector banks, despite the bank going bankrupt, they know they will not lose their jobs and the government will only pump in more and more money. How is the merger going to remove this culture of mismanagement out of banks? We are going to achieve nothing out of these mergers. As I said, you'll only create bigger, weaker, bigger loss-making entities by merging many such entities. The fact is, India needs more banks. The fact is, there are large territories of the Indian nation which don't have adequate, proper banking services. Mergers is not going to achieve anything great out of this, and it will not even solve this problem. The fact is, India is not overbanked. The fact is, India can do with many more banks. A country like Philippines has more banks than India has. And by trying to merge and trying to reduce the coverage and footprint of banks, which is very likely because they've already said branch closures are imminent, we are only ensuring that the Indian nation is going to get lesser of banking facilities for its common man. The long and short of all this is that if you merge many entities which are junk, you don't create an investment grade entity out of them. If you add too many F's, which is junk rating, you don't create an A, which is an investment grade rating. This is Akhilesh Bhargava signing off till we meet again. Namaskar.
Now be the first to know about the latest updates on our new news app. Go on your Android or iOS, search for HW News Network. Download our app, choose the language you prefer to get updates in, and be up to date with the latest news.